Hey everybody, Eric here. Coming with the short put, which is next up. This is the last of our single option series, and this is one of my absolute favorite trades. So let's jump over to the main screen and run through what it looks like. This is a neutral to bullish strategy. So much like the short call, we have that neutral component because when we sell things, we're already realizing our max profit. So we don't need the underlying to move to realize our max profit. So whoever holds the short put has the obligation to buy stock. The max profit is the credit you receive, and you realize that at or above your short strike. Your max loss is technically undefined, and we realize that below our break even price. Our break even is our short strike minus the credit received. Run through a couple market conditions as always. The underlying goes up, helps our position. Underlying goes down, hurts. IV goes up, hurts. IV goes down, helps. So the reason why when the underlying goes up, it helps our position is because it's a put. So as the underlying increases in value, that decreases the value of puts. So we're selling high and looking to buy back lower. Same thing for implied volatility. When implied volatility contracts, it decreases the value of options, makes it cheaper for us to buy back, helps the position. So this is definitely a higher implied volatility strategy, unlike the longs where we want lower IV. When you sell stuff, you want higher IV. For the same two reasons, just inversed. If you sell when IV is high, one, premium is high. That's good. We want to collect when premium is high. But then the second thing is we benefit from IV contraction. So if it's high, it's unlikely to go higher still, whereas if it's low, it can more likely go up. So if we sell when IV is high, we're more likely to experience a volatility contraction, which helps the position. Like I said, these are a favorite position of mine. I sell a ton of puts. Same thing with calls, single options, I sell a lot of them. And then the management on these, you're going to sell to open the position and then look to buy it cheaper to close for a profit. Let's jump over to the platform, take a look at a P&L chart. So as you see, as the underlying goes up in value, we're going to maintain our max profit. The further the underlying goes down, the more we're going to experience a loss. The other thing I want to share is notice how right where we sold it is our break-even point. So it doesn't even have to move, and we could make max profit. Now, unlike the longs, where they already start, remember the purple is right now, and then the blue is at expiration. So notice how the purple line is in the negative for us. The reason being is because there's still so much time value. That's what this gap is. So we want time to pass, so this purple line will move up towards the blue line and help our position as theta decays out. So that is a quick recap of the short put. And then next we'll start actually getting into strategies. Talk to you guys later.